Let's dive right into this explainer, because right now there is a massive sense of cognitive dissonance happening in the global economy. You look at the surface and you see these historic, record-breaking booms in certain sectors, right? It makes it feel like everything is just thriving. But if you scratch just beneath that surface, we're actually witnessing quiet, historic implosions in other major sectors. And here's the crazy part. These seemingly disconnected events happening on literal opposite sides of the planet are actually deeply intertwined. So it begs the question, when real estate crashes and tech bubbles inflate, where exactly does the smart money go? To figure that out, we really need to zoom out and look at three staggering macroeconomic shifts playing out right now on the world stage. By connecting the dots between a housing collapse in Asia, an artificial intelligence arms race here in the US, and this silent global rush for precious metals, we're going to uncover the forces that could directly impact your 401k and your retirement savings. Act 1, the $18 trillion collapse. We have to start in China, where the one asset that was supposedly never ever going to fall just experienced a total meltdown. $18 trillion. To put that staggering number into perspective for you, that is roughly the equivalent of the entire annual GDP of the European Union, just evaporating into thin air. That's the estimated wealth that just vanished from China's housing market. Literally, the last 20 years of gains wiped out in the blink of an eye, and prices have now fallen for 35 consecutive months. For millions of people over there, this isn't just some standard market correction. This is their entire life savings disappearing. You've got entire cities overbuilt, millions of units sitting completely empty, and a construction industry that has basically collapsed. To really grasp how this happened, you have to look at the timeline. Up until 1996, housing in China was largely government-provided. But when it was privatized, urban homeownership just absolutely exploded. Between 2001 and 2017, prices shot up nearly 700%. The whole market was super reliant on pre-sales, meaning buyers were paying full mortgages on apartments that hadn't even been built yet. It created this incredibly rapid but dangerous feedback loop. By 2020, the government realized, okay, things are completely out of control, and they stepped in with a policy called the Three Red Lines. Basically, they put strict limits on developer debt. And man, it instantly crushed companies that were relying on borrowing just to survive. They basically shut off the money printer overnight, leading to giant defaults, stalled construction, and zero buyer confidence. But the true danger of this crash, it comes down to concentration risk. See, because of strict capital controls and a really volatile stock market, Chinese citizens didn't have a lot of options for where to safely park their money. So real estate wasn't just an investment, it was the ultimate foolproof savings account. At its peak, a massive 70% of all Chinese household wealth was tied up in housing. Contrast that with the US, where it's closer to 25%. When you have a 70% concentration, a housing crash isn't just a localized real estate problem, it's a total consumer spending freeze across the board. It's a massive deflationary shock that hits hiring, domestic spending, and even global commodity demand. Act 2, the tech mirage and the AI arms race. So, while China is dealing with a deflating property bubble, the United States is seeing a totally different kind of extreme wealth concentration. This one is driven entirely by the artificial intelligence boom. The entire U.S. stock market right now is heavily banking on American dominance in AI. I mean, the U.S. is outspending China nearly 8-to-1 on AI infrastructure. And we're not just talking about software code. That's $764 billion slated for this year, which, by the way, is roughly 3% of our entire economy, is going into physical reality. We're talking thousands of massive data centers, crazy liquid cooling systems, and absolutely enormous power grid demands. Meanwhile, China is spending just a fraction of that. But guys, there is a massive blind spot in this spending spree. Why is China spending so much less? Well, because Chinese open-source AI models are currently completing the exact same tasks for about 7.5 times cheaper than flagship American models. In industry-wide benchmarks, these Chinese open models are sitting right in the middle of the global rankings, knocking out standard tasks for literally pennies compared to the US models. And in the tech world, that kind of price difference is fatal. If your competitor can do the exact same task for a fraction of the cost, your trillion-dollar infrastructure investment quickly risks becoming a stranded asset. The whole illusion of total American dominance kind of fades when you look at the underlying strategies here. The US strategy is to spend trillions doing the absolute hardest, most expensive computational research in human history. China's strategy? It relies on a process called distillation. Essentially, they train their smaller, cheaper models by studying the answers that are produced by the frontier American models. They literally copy the homework, compress it down, and open source it at a 90% discount. You just cannot build a massive competitive moat, let alone make back a $1 trillion investment when you're trying to sell something that your biggest competitor is basically giving away.
And that leads us to a massive structural financial problem. Think about traditional software, right? It's like writing a book, super expensive to write and edit that first copy, but printing a million more copies is virtually free, leading to pure profit. AI does not work like that. It is much more like hiring a human assistant. You literally have to pay them every single time you ask a question. AI costs increase linearly with usage. Every single prompt burns expensive electricity and wears down specialized chips. OpenAI reportedly burned over $20 billion in 2025 alone. These companies aren't printing money. They are operating massive money furnaces with no clear timeline for profitability.
So how do you keep these massive furnaces running? You aggressively push for record-breaking initial public offerings, explicitly targeting retail investors to raise cash. Take SpaceX, for instance. They're pushing an IPO targeting a mind-boggling $1.75 trillion market cap, claiming 93% of their total addressable market is from their AI business. Anthropic and OpenAI are doing the same thing, seeking public capital. And here is the major danger for you. When corporate insiders and venture capitalists want to cash out of these money-burning furnaces, they take the company public. There's a growing fear that everyday retail investors are just being used as exit liquidity, meaning your 401k or mutual fund manager might be the one buying up those shares at the absolute top, absorbing all the risk right before the bubble potentially pops.
Act 3. The Golden Escape Valve.
Okay, so if foreign real estate is collapsing and domestic tech is facing this massive cash-burning bubble, how are the world's central planners hedging their bets? Well, check this out. For the first time ever, the largest chunk of retail investor money in China is actually sitting in a gold ETF. It recently hit $13 billion, officially surpassing their top stock market index ETF. This is a profound psychological shift. It tells you everything you need to know about a nation's confidence when everyday citizens completely abandon traditional growth assets like stocks or real estate and instead park their wealth in a 5,000-year-old metal. And this is not just retail panic on the ground. It's happening at the very top. The People's Bank of China bought gold for 20 straight months, their longest streak on record, even when prices were temporarily falling. Central banks globally are quietly hoarding about 1,000 tons of physical gold every single year. Meanwhile, the U.S. is exporting record amounts of non-monetary gold, like jewelry, bars, and coins, straight to China. We are watching a very real, physical wealth transfer moving from west to east. So why is all this physical gold moving around the globe at such a crazy pace? It actually ties back to recent U.S. Treasury proposals pushing a return to something called Hamiltonian economics. Essentially, this is a system that uses protective tariffs on foreign goods and heavy subsidies for domestic industry to rebuild a nation's manufacturing capacity. For 50 years, our strategy was simple: send the manufacturing overseas so we can get cheap TVs, appliances, and sneakers. We hollowed out our industrial base for cheap consumer goods. But now, policymakers are signaling a massive reversal. They want to re-industrialize America to counter foreign dominance. But there's a pretty big catch here. Reversing 50 years of economic policy introduces what's called a macro trilemma. Basically, you cannot rebuild American factories, protect Main Street prices from inflation, and keep the US dollar historically strong all at the exact same time. The mechanics are straightforward. If the dollar is super strong, American-made goods are way too expensive for the rest of the world to buy. So to make our factories globally competitive again, the strong dollar actually has to come down. Analysts are suggesting the US dollar may actively need to be devalued to revive domestic manufacturing. In that scenario, global investors need a neutral reserve asset to protect their purchasing power. Enter gold, acting as the ultimate escape valve. Let's just walk through some quick theoretical math to see how high gold prices would actually need to go to balance these current global trade deficits. Take a massive exporter like China, sitting on a $1.2 trillion trade surplus. If they wanted to settle that entire surplus using the 940 tons of gold they just imported, the math works out to a theoretical price of roughly $38,000 per ounce of gold. Now, to be absolutely clear, that is just a mathematical thought experiment. It's not a guaranteed overnight price target. But it perfectly illustrates why central banks are hoarding this asset. They know the current prices don't fully reflect the true size of these global trade imbalances, and they're preparing for a massive financial rebalancing. Which brings us to Act 4, protecting your wealth. So, after looking at the complete collapse in Chinese housing, the incredibly precarious AI bubble here in the US, and this global stampede into gold, what does this giant chess game mean for you and your retirement savings? The biggest takeaway here is the absolute lethal danger of concentration risk. China's market collapsed because 70% of their wealth was tied to a single asset they thought was immune to gravity. Today, we're seeing US investors doing the exact same thing with tech, falling hard for recency bias.
Just because a handful of hyped AI stocks went to the moon over the last decade doesn't make it a law of physics. Whether you're all in on property, a single tech stock, or even physical gold, the ultimate defense mechanism is always disciplined diversification. I want you to take a hard look at your portfolio today. Ask yourself honestly, are you truly prepared for the global macro shifts we've just talked about? Is your financial life totally dependent on just a single number always going up? Because as we've seen from an $18 trillion housing collapse to the frantic cash burn in AI, the market can change the rules of the game in an instant. The macro game board has officially been flipped. The real question isn't just what you're invested in right now, but whether you're playing by the old rules or the new ones. Keep that in mind and make sure you aren't left holding the bag.